you're looking at $14,000 a year that they've falsely generated per taxpayer by stimulating the economy.
One thing Powell said that I think the market liked a lot, I think there's no inkling of tightening. I mean, he still has 2 cuts on the dot plot, which is sort of strange and there was a lot of pushback from the reporters asking questions like, what is this about these cuts on here if you're upgrading your inflation? And it's a good question, but Powell was very much on the defensive, I thought. He doesn't really know. He said nobody has high confidence in their forecast right now because there's too many moving pieces on all of this. But since the Fed started cutting rates back in September, bond yields are still up. And the stock market is really doing very, very little since then.
Your CEO, Andy Constant, joins us now. Andy, great to have you with us. The last time you were on, you made a fantastic call. I mean, you called for the slowdown. And I guess, our question now after you make such a great call is, what is your next call? Because it sounds like, you called for the scare, and now you think the scare is going to become a reality.
Right, and I think that's right. Last time it was about the Fed on pause. They're still on pause. Financial conditions tightening. They've eased a little bit, but they're much tighter than they were last fall. And then it's all about the Trump agenda. And the Trump agenda is, except for deregulation, is anti-growth.
So, Andy, how are you positioned for this anticipated second leg lower?
Right. So I think bond markets are very boring right now because of what I just said. They're very fully priced for a slowdown. Credit, as you said, as we were talking about, could be an interesting place to be long protection. But I don't have much exposure at all in fixed income. I am short equities and planning on, for now, because this second leg may take through, say, for instance, the earnings season upcoming, to become an actual slowdown. I am beginning to short equities again. I'm short them, and I'm going to add shorts on any rally.
Well, if you missed the Fed's decision, they kept rates as is. Seems like there is a lot of uncertainty. Essentially, the Fed is stimulating the economy by not letting as many treasuries roll off. We were doing $25 billion a month, now down to $5 billion a month. So this is putting a nice backdrop in the stock market. What we missed in Jeffrey Gundlach's interview was the fact that he is predicting recession over the next couple quarters here, and Andy Constant is putting his money where his mouth is. This guy has been more accurate than anybody on the street. While everybody was coming into the new year bullish, Andy was shorting the market here, saying that a lot of Trump's regulation, while it may be needed, is dampening growth opportunities, and now he's starting to cash in on that and doubling his short position as we head into April 2nd, where tariffs are going to be put in place, and who knows what's really going to happen here. Then we had FedEx report earnings. Now, to me, FedEx is definitely a bellwether for the strength of the economy. If FedEx is producing good numbers, to me, that means economic activity is going to be strong. There's a lot of positive things going on with small businesses. And we see here that it was a pretty bleak outlook, and earnings were kind of disappointing here as the stock fell over 10%. When we take it from a 6-month high, we can see that the stock is down nearly 25%. Nike also reported pretty bleak numbers. They're projecting out negative 10% revenue. Obviously, this is bad news for the stock. The stock was down over 11%. And if we take it from its 6-month high of nearly $90 a share, the stock is down 24%. Now, I gave you guys a warning on Nike stock. Valuation was extremely high. My concern was exactly what happened. If we go into a slowing economy, if we go into higher tariffs, and in turn, that would also impact the multiple on the stock. So there's double headwinds for Nike that I was projecting out. Now, as you can see by this video, the stock was nearly $95 a share when I reported this video, and we can see that it collapsed on earnings. So we had an ideal stock price of around $65 a share. And if we come down here, we can see that this video was done over 8 months ago. This is definitely one that's going to age well. This was a concern of mine. Paying a premium for Nike was definitely a concern of mine into a slowing economy. And this was 8 months ago. So we were definitely a little bit ahead of the ball here. And now it's really hard to really put a price target on a company that is showing negative double-digit growth. Now I'm starting to rebalance my portfolio. As most of you know, I am outperforming the market slightly here. We're up 4% year to date, and I definitely think you want some dry powder on the sidelines for some pretty good opportunities. So we're only in correction territory now, but I can tell you personally what's going to happen with the channel here soon. is I am getting a part-time job that I think is very defensive, and 100% of my check is going into an index. I'm not trying to figure out who's going to win and lose in this. I just want to get my money in the market, as I do think it's going to be a rough couple years. So I will be sharing that after I get through training and we start putting that capital to work. So this is going to be a different account that's going to be accumulating along with the brokerage account that I keep you guys in tuned with. I don't want to miss the opportunity I think is coming, so I want to get money in the market as the market's coming down. I don't want to try to time this. I have a lot of cash on the sidelines, but additionally, I want to start averaging into an index, so I'm getting a part-time job to physically do that, which I will be sharing with you guys on a weekly basis along with weekly updates here. If we look at the sector tracker over the last 5 trading days, we can see that the S&P 500 is up 0.5%, but specifically energy, financials, and healthcare are starting to lead the way. So if we start lining that up with where we are in the market, I definitely think we're starting to reach market peaks here. We might have a market top in or forming a market top when we look at the sector performance here over the last week. And while we're reaching extreme fear on the fear meter, there's something I want to share with you guys. I don't believe we've had that washout that is going to be coming here. Now, I do think we're at a tradable bottom here. We could be looking at a 4, 5, maybe even 6% bounce here over the next week or so, but I don't think we're out of the woods, and I'm going to show you multiple reasons why that is. What you have in front of you is the percentage of S&P 500 stocks trading above the 200-day moving average, and we can see that it was over 80%, has fallen drastically to now roughly 41% of stocks are trading above the 200-day moving average. But what we really want to see for extreme readings is it to get in the teens here, about 12 to about 13% of companies. When we get only 12 to 13% of companies trading above the 200-day moving average, this tends to be a good indicator of extreme oversold conditions and max fear within the market, which does lend the opportunity of buying opportunities as we see here. And so while we're starting to curve down here, yes, we could be just looking at a bounce, but what do we notice? Normally when we start getting these extreme readings, we don't just end there. We can bounce back up and then we have a flush out. So for me, this really does look like, and we've seen it over here before as well, we bounce down and then we flush out, bounce down and flush out. So multiple time frames that we can see that it does look like there's possibly more pain coming when we talk about more stocks in the S&P 500 trading below the 200-day moving average. We normally have that high volatility. We break above 30, and that's the key area that I personally look at. We haven't really broken above 30 in some time, but you guys can see here, we get that flush out above 30. And then that tends to be the great buying opportunities. We get the flush out above 30, get the flush out above 30. Numerous times we get those flush outs above 30. And while it did hit as high as about $29, while it did hit about $29.90, we want to see it break above 30 hard, about 32, 33, flush everything out. And that tends to be where the bottom comes in. Set up to have here, a lot of the indicators are oversold. We are set up to have a nice rally here. But if you take a look at the negative configuration that we've been in for an extended period of time, we've been in negative configuration for an extended period of time. And normally when that happens, it takes a little longer to correct. But we could get some sort of catalyst here. Maybe it's a trade deal that gets us back above the 200-day moving average. We close above that. And I definitely think we can be looking at another story. If we start rallying back up and we start failing somewhere here in the middle, I tend to think that this is a false breakout, but I tend to think if we stay below the 200-day moving average for a longer period of time, we get these moving averages rolling over here. I think summer is going to be a brutal time frame regardless here. So of course, this is just all my opinion, but we are set up to have some sort of rally here. The reason why I want to show you guys what Doge has saved so far, they saved 115 billion. Obviously, this is not a lot of money, I guess, to most people, but it's starting to make a dent into a lot of different areas. Obviously, I've talked about this could be impacting the labor markets. Spending slows down. That'll also impact the labor markets. So just the fear of spending cuts and just the fear of an uncertainty with taxes is going to cost people to stay home and probably not spend as much. Maybe they're scared of losing their job and they're not going to go out and spend as much. This is going to cause economic activity to slow, which then will cause possibly more layoffs as well. So I do think there's this domino effect that's getting very discounted in the stock market right now that I think could be a lot bigger than people anticipate. So with that being said, $115 billion of Doge savings is about $715 per taxpayer. Now here's what I want you guys to think about. Over the last 4 years, we've spent $2 trillion more than what we take in. And so we're spending 40% more than we actually take in. The government's been putting an additional $2 trillion into this economy. Whatever way you want to look at it, it's been put into this economy with an accommodating Fed for the most part. So $2 trillion would be about 20 times what Doge has saved on taxpayers' money. So if we just take simple math here, now this administration is trying to make cuts. Who knows if they're really going to make cuts? Who knows what's really going to happen here? But I just want to illustrate something here, that the government has been basically giving us $2 trillion of additional spending every single year. From a stimulus standpoint, if they're taking $115 billion and that impacts us $714, what does the impact of $2 extra trillion of annual spending really impact the economy, or per taxpayer basis? You're looking at 14 additional falsely generated per taxpayer by stimulating the economy. That is now wiped out of the system if we're really talking about initiatives to save. And I want you to think about how that impacts growth and why Andy Constant might actually be onto something here about possibly looking at growth decelerating at a higher pace than everybody's anticipating. I don't think we're in stagflation, because I don't think being under 3% is anything eye-opening. Now, if we start getting above 3%, I would definitely think that could be stagflation. But I think where this comes to fruition is the labor markets. I keep saying it. We've already had negative GDP, right? That did not lead to a recession. So the only thing that's going to lead to recession, in my opinion, is obviously GDP going negative or possibly slowing down, decelerating. But the true economy is based on employment. I think if you're taking $14,000 per tax, I think if you're not stimulating $14,000 per taxpayer by printing money, then I do think that impacts growth longer term. Now, it might take a few quarters to pop through, as Jeffrey Gundlach has stated, but when I start really looking at this, it is pretty eye-opening here. So as always, guys, that was the recap this week, and hopefully you enjoyed. We will see you all in the next.